Last week, the Finance Minister announced an additional tax on REITs or real estate investment trusts, which are a listed investment on the Indian Stock Exchange. The Union Budget has now made a provision to tax income distributed by REITs and InvITs, both in the form of debt and interest repayments at the hands of the unit holders. How will this impact the returns that you will get as an investor in REITs? After all, this was one of the safest way to own and participate in the growth of India's quality Grade A office assets. And it was also a relatively new one. Joining me for the discussion, Vikaash Khdloya, CEO, Embassy REITs, Sameer Kaul, MD and CEO of TrustPlutus Wealth, and Gagan Randev, Executive Director at India Sotheby's International Realty. Well, since the announcements, all three listed REITs have declined between 5 to 7% in their unit price. Vikaash, let me come to you first. Can you break down this tax change for us and tell us how were REITs taxed earlier and what will be the tax now?
Sure, Manisha. Thank you for having me on the show. So basically, the distributions by REIT can be are comprised of three components: the dividend, interest, and what you just mentioned, amortization of SPV debt. So earlier, what used to happen is that only the interest component was taxable, whereas both dividend and the amortization of SPV debt were considered tax-free. Now, what the recent budget announcement has proposed is that the amortization component, which in our case is about 40% of the distributions that we make, now will be taxed at marginal rate under other sources bracket, and the tax rate depends upon each individual investor. So that is what the change is, that this amortization of SPV debt is now become taxable.
So in simple terms, what I will get as an investor has gone down post-tax.
Yeah, so if you look at it, the distribution yield is impacted by around 0.5 to 1%, but it's important to note that REITs are total return product targeting mid to high teen returns. So let me break that down. One, today roughly the pre-tax distribution yield in our case is say over 7%. The new tax proposal impacts this distribution yield incrementally by 50 to 100 basis points based on the investor category, which basically means, in other words, that 8 to 16% of the distribution component of this product gets impacted. However, Manisha, it's important to note that the budget announcement does not impact the growth levers and the growth upside of our business.
Vikaash, I'm going to come to that later. This is very confusing for the audience. Let's just stop at what you said. You said, look, there are two components of a REIT. One is the dividend which is distributed, which is mandatory, that a REIT should distribute 90% of what it earns. But you also say that don't look at it just by distribution yield, which has been around 6.7. The last one that we have for the full year is 6.7% for Embassy Office Park. You also have to look at the capital appreciation. Okay, hold your thought there. Sameer, let me come to you. I'm looking at the REITs prices, right? Embassy Office Park, IPO price 300 rupees. It did touch a peak price of 480, but today it's barely above its IPO price. And if you look at Mindspace, from 275 to 381, now down to 308. Brookfield, 275 to 340, now down to 272. So anybody who's also saying, hey, I'm a long-term investor here, I'm getting dividend yield, and I'm also looking at those teen returns that Vikaash just spoke about, because I'm hoping that my units will also appreciate in the capital value. That really hasn't played out. Why?
See, first of all, I think when you look at the asset value per share, right, I think the current price is at a significant discount to the asset value. So that tells you that there is potential in terms of capital appreciation. Now, the question is that why is it that the price went up and came down? I think there are multiple factors at play. And some factors are common to the REIT category. For example, interest rates have gone up. That has impacted, the price. I think there was a period when the occupancies had declined, especially in the COVID and immediately post-COVID era. So that has also impacted the sentiment. I think with interest rates going up, investors have choice today because earlier at 6% post-tax, it was a very attractive proposition. Today, in a mutual fund, you can start to look at getting 7% on a post-indexation basis. And I think the other challenge is that as the area available for lease has gone up and the net operating income has gone up, unfortunately, because of REIT-specific issues, the net distributable cash flow is not going up. So what is happening is that, for example, in the case of Embassy, they've actually issued debt and increased the number of units. So the distribution per unit actually is coming off. So I think these are the kind of factors which have impacted sentiment. Like I said, if the REITs are now able to show a sustained growth in the NDCF, then I think that there is value because it's the price is at a discount to its book value.
Book value. Okay. Gagan, come in here. I mean, I did a post-budget discussion and from Anshuman magazine to several other experts, they said, what an ill-timed, taxation brought in by this union budget because REITs is a very new investment vehicle in India and maybe we could have left it untouched. But well, that's a bygone. Do you believe that currently looking at the REIT prices and they're not too much above their IPO price, there is room for capital appreciation because dividend yield, I think, yes, it's got compressed also because of rising interest rates, as Samir has said, and other host of factors where it's not been possible for REITs to distribute that much.
No, absolutely, Manisha. But before I come to that, I think this tax thing, while they probably did it with the right intentions, I think the way they've gone about it is slightly wrong in the sense that. And I've had calls with most of the people running REITs in the country. And I think the biggest point of contention and this is what they have gone to the industry. There is going to be a representation made to SEBI, to the finance ministry, etc. And that is the way about taxing it is rather than taxing this repayment bit as other income, which gets taxed at your marginal tax rate, it should get taxed at the capital gains rate, which would be 10% or 15%. Because the way it is currently thought through, it would actually affecting yields by almost 100 to 150 basis points in the extreme situation. So this is something which has to be done. The other thing we have to realize is worldwide, in the case of SPVs and REITs, there is no tax which happens at that level. Taxation happens at the unit holder level. In India, it is also happening at the SPV level as well as the unit holder level. So I think for this industry to grow, I think this anomaly will have to be sorted out. And I personally believe that there is a good 90% chance that they are going to change this from other income to capital gains. Now, coming to your point, do you see appreciation from here? There is going to be a little overhang, till there is clarity on how this is going to be set right. But having said that, if somebody were to invest into the commercial market, there is no better way than doing it. I think today you're seeing the clear trend where the buildings which are not strata sold, which are fully leased, are commanding better rentals, better
Right.
yields, better occupancy than strata sold buildings. So, there are models available where you could take fractional ownership, but those are illiquid, they are opaque, you cannot utilize debt on them. So the better structure in all
Is a
markets
REIT.
would be a REIT model.
All right, Gagan, point well taken. Let me lobby back to Vikaash. Vikaash, you were talking about the fact that long-term growth story remains intact, and I know it must hurt to see the EOP listed price of the unit almost back to the IPO level. Tell me why, because I'm also seeing a lot of inventory coming into the market and Hyderabad specifically. But if you look at tenants, they could just look at Bangalore, but they could also look at Hyderabad if there is enough arbitrage in terms of rentals that they have to pay. So why are you so confident that those teen returns will come back? Because they were there. I agree with you that, even I am invested in REITs and I did see those teen returns at a point.
Sure, Manisha. So let me break it into three parts. I'll be quick. First, we spoke about the share price. I don't want to comment on the market volatility, but clearly it appears to be an overreaction to the recent budget, right? We have done fabulously well, given that 2 years post-listing was in the shadow of the pandemic. And our retail investor base, in fact, during the same period has grown 18 times. So this product works and it really delivers to the unit holders, as we have seen globally. Now, coming to your point on Embassy REIT itself, we listed at 300 rupees per unit in April 2019, which is about 4 years back. But since then, our operating area and our under development area has increased over 30%. Our occupier base has increased over 40% to now 230 occupiers. And our NOI, the core metric that we focus on, the net operating income, that has increased an incredible 72% from 1,600 crores at IPO to 2,700 crores, which we're expecting by the end of this year. So our conviction remains really strong, and this is an ideal product for investors. And I want to reiterate, that's a total return product. Yes, the capital appreciation part, as we spoke about, there's been an overreaction in the market, and the stock is where it is today. But that does not change the fact that fundamentally both the portfolio is poised for growth in terms of the levers we have, which is both contractual rent escalation, so rents keep growing over time. These are all the multinational occupiers we're talking about. They continue to grow in India. We talk about occupancy uptake. So while we've been resilient on occupancy, our pre-COVID occupancies were somewhere in mid-90s. So as we see an uptick in occupancy, we'll see growth in NOI and distributions. Plus, there's a huge mark-to-market rent potential. The potential to get the rent, enhance the rents back to market levels. Plus, you must remember that we are undertaking one of the largest components of under construction development, organic growth in the history of our company. So right now, as we speak, we are constructing 66 lakh square feet at about 24% yields, one of the best matrices. And this is obviously going to add value. So all of this put together, of course, we believe that we are very well positioned and offer one of the best risk rewards to investors.
Sameer, I'm going to ask you because, this is more about the returns that REITs are going to get, or any investor can get. You spoke about an inverse relationship between REITs and a rising rate scenario. But do you think the time to enter back REITs should be when you think interest rates have peaked? Because from there on, in a declining market, could they be outperformers? Sameer?
So like I said earlier, Manisha, I think if you look at the one name I took, if you look at the total, asset value, when you divide it by the number of units, I think it comes to a price which is significantly higher than the current price. So from a value point of view, from a capital appreciation point of view, I very much think that these are very good levels to get in. I would just kind of caution investors on two things. One, I know that Vikaash was talking about the expansion. I think as an investor, we would like to see a consistent growth in the distributable cash flow, which is something that we haven't seen for the last few quarters. And the other thing is that you talked about occupancy. I think that in cities like Bangalore, I would be very surprised to see high levels of vacancy given the quality of premises that some of these REITs own. I think there are pockets in Pune and Mumbai and maybe even Hyderabad where the occupancies are not as high as they should be. But having said that, I think that from a long-term perspective, in my view, REIT continues to be a very good asset class to allocate your money to. And again, if you start to see interest rates come off, you will probably see the resultant benefit in terms of capital appreciation. But I think what people want to see is a sustained growth in the distribution per unit. And I think that is what has been missing. And that's what really I think the REITs are now, they have to make it work for the
Make it work and make it happen. Well, Vikaash Khdloya, that's a message you can take back from this show. I'm going to wrap it out here, but yes, long-term portfolio.
If I can just add one point, I think the REITs will also have to get into a little bit of structuring, because if you know today, there's a little bit of convergence or divergence in our rules. The REIT structure envisages that you have to pay out 90% as distributable flows to your unit holders. But you're also governed by the dividend policy of the Companies Act in India. So the structure of equity and debt, which has been created, also assumes significance, because while you may have cash, you would need to have a structure which allows for efficient distribution of the cash you hold. So that is something also that the REITs will have to work out. And, and I think this tax puts a little bit of, I would say the CFOs would really have to put on the thinking caps to structure this.
All right. Okay. Well, hope whatever the thinking caps are and whatever, requests are going to the finance ministry, some of these are looked into, because it is a good product for both a combination of capital appreciation and annuity income. Gentlemen, thank you very much for joining me today.
Thank you.
When we return, we move to an exciting prop tech avenue, which is metaverse. Now, can metaverse really transform the way you buy and experience real estate? Stay with us to know the latest on that and how an Indian company is cracking the code.